Now let's look at the commodities space with Damilola Kimami, Head of Research at Financial Derivatives Company. Hi, Dami.
Good morning,
A wet
Chimeze.
morning today.
Yes, it is.
But I mean,
and cold.
It's all good.
Yes.
All right. Yeah. Well, we've seen some kind of reversal on oil prices from what we saw on Tuesday.
Yes.
Oil hitting about $80 on Tuesday, and this is coming. This decline is coming ahead of OPEC's meeting next week. How would you describe the scenario that is actually playing out now in the global oil market, and how do you see this shaping the meeting, I think, on Monday?
Yes, on Monday. So, first of all, like any other commodity, the price of oil is volatile and is subject to what is happening to supply and demand. And on Tuesday, we saw oil price rally to a 3-year high of $80 per barrel due to rising demand and what have you. But what is driving the fall in prices now to about $77 per barrel is the increase in U.S. crude inventories. That was unexpected. Analysts were projecting a decline of, or perhaps even all inventories remaining at the same level. But we saw that there was an unexpected increase, and that dampened sentiment and pushed down prices, because obviously increased supply would soften prices. So that's what we're seeing right now. Ahead of the meeting, what OPEC Plus, that's OPEC and its allies, Russia and all that, what they're going to be considering, they're going to be looking at the market fundamentals. Because, you know, on Tuesday, we talked about the fact that we have a supply deficit. So there's a tight supply in the market, the fallout of the Hurricane Ida, and how that locked in about 30 million barrels of U.S. crude. The fact that OPEC Plus, the output increase of 400,000 barrels per day on a monthly basis, that is yet to have the desired effect, coupled with the fact that a lot of countries are increasing their vaccination rate. We're seeing a pickup in fall demand. We're moving to the winter season.
Oil price remaining up.
Exactly. So they're going to be considering these factors. That is, demand rising faster than supply. Do we need to be more aggressive with our output increase, or should we maintain the current costs? So those are some of the things that are going to be discussing at their meeting next week, Monday.
Well, we heard the OPEC Secretary General Bakindo speaking ahead of this meeting, sounding quite optimistic about of course, the demand and oil price, and he maintains that oil will, of course, continue to be a leading energy source for a decade. And this is despite the world moving away from fossil fuel.
Yes, so one thing we need to understand is that the major trend or shift that we're seeing right now occurring in the energy space is the shift to renewable energy. The fact that a lot of countries are cutting down their gas emission. And these countries that are at the forefront of this renewable energy revolution are some of the major oil producers and oil consumers. So, for instance, the U.S., we know that President Biden in August has said that he wants about at least 50% of the cars sold in the U.S. by 2030 to be zero emissions. So the fact that countries like U.S. are beginning to have said that they're going to reduce their gas emission and reduce their gas emission, reduce the number of cars that use gas emissions to zero. That means that the demand by these countries are going to fall, and U.S. is one of the major global oil consumers. And the fact that they're cutting down, they've also agreed to cut down on their production of even these fossil fuels, meaning that U.S. production and oil share of the market is going to reduce, and that gives OPEC an opportunity to gain more market share. Bear in mind that 2 decades ago, OPEC was the largest, or was controlled the largest share of the oil market, and then U.S. oil came in, shale oil, and that displaced OPEC. So in the next 2 years, because of that shift to cleaner energy, it gives OPEC an opportunity to gain more market share. It gives OPEC an opportunity to control price. It gives OPEC even an opportunity to determine whether to ramp up production or reduce. So basically, it's going to be like the central bank of the global oil market. So for OPEC, yes, this is good news. And like the president rightly said, oil and gas is still going to be the major energy in the next couple of years. But that doesn't mean that you're not going to continue to see that shift. So for Nigeria, who is not a major player, because bear in mind, Saudi, who is the major OPEC player, Saudi has significant oil reserves. Saudi has significant even external reserves. So, for instance, when the OPEC quota, when they were quite strict with it last year, 2 years ago, Saudi still had some funds to fall back on. But Nigeria was affected because we were forced to reduce our production. So in a situation like this, it's the bigger players, the richer countries that stand to benefit. So for a country like Nigeria, yes, oil and gas is still going to be there, the demand is still going to be there, but that doesn't mean we should sit on our hands and not invest. We have to start thinking about how we can shift and join the world, join the bandwagon in this shift to renewable energy.
Well, this morning we hear China's PMI drop in. China, of course, is the world's biggest crude importer and I think the second consumer.
Yes,
so how would this also affect the global oil market and, of course, the global economic recovery?
Yes, so what is driving that, or what led to that contraction in China's manufacturing activity is because they're experiencing energy crisis, so coal prices are significantly high, and that has led to some power outages, and so they've had to shut down some of their factories, and output has been affected. And bear in mind that China depends significantly on its manufacturing sector. The manufacturing sector accounts for about 26% of China's GDP, so definitely that's significant. That's why we saw that fall in the PMI to 49 points thereabout. And bear in mind that anything below 50 is the threshold. Anything below 50 indicates a contraction, and anything above that indicates an expansion. So for the world, China is a major global powerhouse in terms of investment, in terms of trade. Like you rightly said, it's the second largest oil consumer. So it signifies that something is happening. So if they're not producing as much, definitely it will affect global trade. And for Nigeria, China accounts for about 25% of our imports and about 27% of our exports. So if China is not producing as much, there's going to be shortages, meaning that what we are going to be buying from them, the prices of those commodities might increase as a result of supply constraints. So it's very important. Also, we receive about 12–15% of our bilateral loans from China in terms of investment. So China is a major trading partner and investment partner for Nigeria and even emerging markets. So whatever happens to that country is important to us.
Now, we're also seeing EU Economic Confidence Index rising 0.17%. That's also giving also U.S. economy to recover. Yes, 6.5%. And this is despite the continuous rise we have seen in COVID-19 cases. So what does this say generally about global economic growth?
I think what it just shows, or it's an indication of the fact that both consumer and business sentiment it's more optimistic. So investors are more optimistic, consumers are more optimistic about these economies. So for instance, in the US, what is driving that is the increased vaccination rate. So because more adults, the adult population are getting more vaccinated, so a lot of companies, businesses are reopening, and that obviously is pushing consumer spending. And the more people spend, the more you'll be able to spur growth, because what you do in a recession, you spend your way out of a recession. So for Nigeria, these are, again, our major trading partners. So the fact that Eurozone economic confidence sentiment is positive, the US is projected to recover and grow by about 6.5% in Q4. That's positive for us in terms of trade. The EU accounts for about, the EU is the largest, the Eurozone is the largest trading partner of Nigeria. We get a lot of aid and investment also from the US. So it's positive for us because, again, that it means increased trade flows, increased economic activity, increased diaspora remittances, which obviously would impact positively on our external reserves.
All right, so looking at those developments in the oil market and, of course, the global economy in general, back here, of course, yesterday, the reps also approved the
2022 to 2024
just as the Senate did. We had assumption of 4.89 trillion naira. That's for the new borrowing, and then $57 per barrel,
oil price.
Yes, and 1.88 million barrels per day of oil production. So how do you tie this with what is happening in the global economy, in the global oil markets? How realistic are these?
Well, first of all, for oil price, right now, the average oil price is at least above $75 per barrel. And if this trend continues into 2022, so having a benchmark of 57 is still relatively, that's optimistic. At least it gives us enough headroom. But more importantly is the production aspect because we're producing about 1.2, 1.3 million barrels per day.
Not even meeting the OPEC
not meeting the OPEC quota, not meeting the production benchmark. And bear in mind that your revenues are based on both price and production, not just price. So we need to ramp up our production in order to boost our revenue profile. And also because right now what they're projecting is about a fiscal deficit of about 5.6 trillion naira. If you fall short of your revenue projections, that fiscal deficit is going to widen, meaning that you have to borrow more. Like you rightly said, they've approved 4.9 trillion naira for borrowing. But if for whatever reason we have new variants coming up, altering or affecting the recovery process, then all bets are off and you need to borrow more. And that raises the concerns of Nigeria's debt sustainability plan. So I think for now, we should focus more on trying to build and increase our oil production.
Right. Okay, we have just come to the end of the third quarter and, of course, the end of September. So bring us up to speed with the outlook for domestic commodities prices going into the new quarter.
Okay, so what we're seeing right now, we actually recently conducted a survey yesterday, and what we're seeing right now is that the harvest season is coming to an end with, because we're beginning to see a lot of price increases. In fact, based on our basket survey, most of the commodities in our basket recorded a price increase apart from two, maybe new yam and cement, that the prices remain flat. And also what we're experiencing that there are some blockades occurring around the Niger Delta, which is preventing the supply and logistics and distribution of goods and is affecting perishables the most. So for instance, onions and whatever. So the price of these commodities are increasing. And as you move towards the festive season, December, where you have a lot of activities, weddings, events, and end of year parties, there's going to be that increase in demand for commodities, especially festive dependent or related commodities such as rice, pepper, vegetable oil, turkey, chicken. So you're going to see that increase in demand. And once that increase in demand, coupled with the fact that the harvest season is coming to an end, you're going to see that price increase. So inflation, with that declining trend we've been seeing in the past couple of months, could reverse, and we might start to see prices, inflation rate inch up in Nigeria.
Okay, we'll wait and see.
Yes.
Thank you very much, Dami.
Thank you, Chimisi,
we do appreciate
for having
your time
me.
and enjoy the rest of the day.
And you too, thank you.
All right, we take a moment. We'll be back.